This chart shows the classic stair-step progression of gold during the European morning. It's 7:59 a.m. Eastern Time, and the technical trend looks incredibly steady. Volume is moderate, and the price action is clean. Many traders see this as the perfect setup. They identify the support levels, assume the trend will hold, and execute a long position based on these technical indicators. Then the clock hits 8 a.m. Eastern. Instantly, the price collapses. It rips through those support levels, hits the stop-loss orders, and then immediately rockets back up in the original direction, leaving traders behind. This volatility marks the institutional handover. At this precise moment, European desks are squaring their positions for the day, while American institutions begin deploying billions in fresh capital into the market. For 4 hours, London traders have driven a cautious, trend-following strategy. But when New York opens, their volatility-seeking capital collides directly with that established European trend. Treating a gold chart as an isolated technical puzzle between 8 a.m. and noon guarantees you will become the liquidity for those major banks. To survive the handover, you first define the London morning range. Map the highest and lowest points reached between 3 a.m. and 8 a.m. Eastern to create a clear price channel. This range acts as a sandbox. Institutional algorithms are programmed to look for the clusters of retail stop-loss orders, resting just a few pips outside these upper and lower boundaries. Before looking at gold at the New York Open, smart traders check the macro engine driving the system, the US dollar index and the US 10-year Treasury yield. Gold shares an inverse relationship with both assets. If Treasury yields spike in the first 30 minutes of the New York session, they exert an immediate, heavy gravitational pull downward on gold. At the open, gold often pierces the London high in a Judas swing, triggering retail buy orders to generate sell-side liquidity. Once filled, the price aligns with rising bond yields and crashes back down through the morning range. True institutional moves require sustained volume to hold a new price level. If a 5-minute candle fails to maintain its breakout and closes back inside the morning range, it confirms the move was a temporary liquidity grab, signaling a short entry toward London lows. Ignoring the bond market at the New York Open turns a seemingly clean technical breakout into a fatal divergence trap. At 8:30 a.m. Eastern, the U.S. releases red folder economic data, such as the Consumer Price Index and non-farm payrolls. A hot CPI print strengthens the U.S. dollar immediately. That data can instantly override whatever trend London established earlier in the morning. When the news hits, the initial price candle is often massive. The emotional temptation to chase that movement and click buy during a rapid surge is how traders get trapped in a reversal. Apply the 15-minute rule. Take your hand off the mouse and let the initial volatility whip for a full 15 minutes until it finds a temporary floor. If the news justifies a genuine trend, the market will offer a clear pullback. Wait for the first clean retracement after that 15-minute window to find a safe entry point. At 11 a.m. Eastern, the London fix begins. This is the moment European institutions square their books for the day and head for the exits. As European capital is withdrawn, the market experiences massive profit-taking. This institutional exodus often triggers aggressive mean reversion, reversing much of the morning's price action. This chart tracks the volume-weighted average price, or VWAP. During the 11 a.m. hour, if the price drops below this line while the volume at the bottom expands, it confirms the smart money is exiting their positions. Surviving the second half of the power hour is about executing disciplined, mechanical rules, while the rest of the market reacts to the noise. Trading gold is about more than chart patterns. It is about anticipating a daily schedule of institutional baton passes. You are operating in a market controlled by the largest liquidity providers in the world. They have the capital required to move the price wherever it needs to go to fill their institutional orders. Because of this volatility, standard retail risk management often fails. You must scale down your lot size to accommodate a wider 25 to 40 pip stop loss, allowing the trade room to breathe during the overlap. The power hour offers the cleanest moves of the day, provided you respect the clock and let the banks reveal their true intentions first. Start mapping your own charts today. Download our NY Overlap checklist to apply the precise parameters of the London range breakout strategy to your terminal. Then join thousands of other traders on NX1 at FXNX. With 0 pip spreads and institutional-grade execution, you can finally trade alongside the smart money, instead of being the liquidity they hunt.